Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Palantir weighing on stocks as concerns rise over sky-high valuations. We'll dig into those results ahead. Plus, we'll hone in on Uber and Spotify as those companies report results. And we'll hear from Fed Governor Austin Goolsbee as he casts doubt on the odds of a December rate cut. Taking a look at the major averages here, we definitely have a risk-off session, but already the selling has abated to some extent since the opening bell rang. Right now, we've got the Dow off by 170 points, only about 1/4%. The S&P 500 off about 0.6 that. Pretty steady here. And the NASDAQ, the big loser of the day, down about 0.8%. But you look elsewhere, you can see signs of this risk-off attitude in the market right now. For example, take a look at the Russell 2000. It is down more than the major averages, off by more than 1%. Take a look at what's going on in the bond market, where you have buying of treasuries that is sending yields a little bit lower. It's not a big move, but it is a bit of a mood there. And then you can also take a look at Bitcoin, which I know my colleagues were digging into in the last hour. This sharp move lower that, of course, is not just today. It's been over the past several days. So just to look at that in a little bit more detail, here's the 5-day chart of Bitcoin, and we've seen that leg lower that has been going on. Interestingly, though, even though it is a risk-off vibe today, gold is not one of the assets that's benefiting. It is down as well. But this risk-off tenor certainly extends to what's going on within big cap technology as well. There's some concerns here about valuations. Nvidia shares off 1.5%. Michael Burry, who became famous during the financial crisis for shorting the housing market, was part of The Big Short, that book and movie, coming out in a 13F filing and revealing that he had bought put options on Nvidia as well as Palantir. That is benefiting if the stocks go down. So that's something that caught people's attention, as well as some commentary out of some financial services CEOs at a conference in Hong Kong talking about valuations as well. So a decent amount of red on the screen here when you look at the NASDAQ 100, and one of the darkest reds is Palantir, although even Palantir is not down as much as it was earlier here. And if you look at the year-to-date chart here, you still have a more than 150% gain in those Palantir shares. But let's dig into Palantir here, what's going on with the stock today, and what could be going on next. Valuation concerns, of course, have been weighing on these Palantir shares, despite the company topping third quarter estimates and raising its full year guidance. Joining me now is Gil Luria, DA Davidson, head of technology research. And obviously, Gil, there are two things going on here. There is the fundamental story of the company, and then there's the stock story of the company. On a fundamental basis, in these numbers, was there anything not to like?
No, the results were spectacular. They exceeded any expectations anybody could have. This is a company that's more than a $4 billion run rate, growing 63%. It's more than doubling its commercial business. And these aren't little deals. They have some customers that spend as much as 9 figures on Palantir software. So companies are lining up to use Palantir in order to achieve their AI goals. The government business grew 50%. The government's still leaning more and more on Palantir to achieve its own mission critical goals. The stock is down today. That has nothing to do with the fundamentals from last night.
Okay, so what does it have to do then? Is it just a valuation question, and this was sort of a sell the news kind of situation?
More likely. I actually think it has nothing to do with Palantir. To your point earlier, this is more about a risk-off vibe today. Nothing more than that. You can see a lot of the higher multiple, more AI exposed companies, stocks being down today. Again, I can't imagine anybody expected Palantir to do better than they did last night.
I mean, but at the same time, Palantir's price to sales are something like 85, the highest in the S&P 500. Even if this company is fantastic, does it deserve the valuation, the multiple that it has?
You know, that's the tough question, because the both on the price to sales, price to earnings, EV to cash flow, there's no way to justify Palantir's valuation. It is completely divorced from fundamentals and from any other valuation of any other company, which is understandable because they're doing so much better than any other company. They are by far the best software company. But the valuation, it's hard to justify. It's hard to tie it to a cash flow, a discounted cash flow. It really is. Investors that buy Palantir are buying it because they expect the growth to continue for the foreseeable future and beyond. It's a very individual investor based stock. And so it's very hard to argue should be trading at 80 times EV to cash flow, EV to sales, at 100 times EV to sales, at 60 times. It's very hard to argue. These are all arbitrary numbers, and hence the challenge, and hence a day like today where, again, the results couldn't have been better and the stock is down.
Well, okay, so Gil, let me ask it this way then. What is the total addressable market for a company like Palantir, and is there anyone really competing with them directly in what they do?
So there is no ceiling for Palantir anytime soon. Just to give you proportion, again, they're more than 4 billion run rate. Adobe's 20 billion run rate. Salesforce 40 billion. Oracle 50 billion. There's nothing limiting Palantir's growth. That's part of the excitement. That's part of how investors are justifying this very high multiple. And then in terms of competition, everybody's trying to do what Palantir is doing, which is help companies get to their AI goals, and nobody is succeeding as well. And it's not an accident. Palantir is an overnight success story, 20 years in the making. They do some things extraordinarily well. They help companies and government agencies collect disparate data sources, combine them so you can use AI without compromising the privacy and confidentiality of those data sources. They give companies the soup to nuts service in terms of all the software components, all the services components, instead of those companies having to cobble that together from different software companies and third-party consulting and internal IT. Those are two very unique capabilities that really nobody else is doing and are actually kind of hard to replicate. That's why Palantir is doing so much better than anybody else. And again, the sky's the limit because at their size, they can continue to grow at these rates for many years.
So, Gil, you've got a neutral rating on this stock. And is it just because of what you said earlier that it's hard to, it doesn't fit neatly into the financial models that folks in your business traditionally use? Is that the issue?
That is the issue. I'm just a curmudgeonly old sell-sider, and I feel like multiples matter and have to make sense and at least be anchored to other multiples for other companies or historical multiples. And as we said, with Palantir, that's not the case. The multiple is so high that it really is divorced from fundamentals. But again, great company with a great mission doing phenomenally well.
Gil, I do want to ask you more broadly about the risk-off movement that we're seeing today. As I mentioned, you had the Michael Burry filing, right, about the put options on Palantir, as well as some charts that he posted on X. Is there a bigger question to ask, and where do you stand on that bigger question of where tech valuations are right now? You've heard it all. We've talked about it before, the circularity of the spending with OpenAI at the center. How are you thinking about it right now?
There's two categories. There's the real companies that are doing real work and are actually not trading at a very high multiple. Microsoft, Amazon, Google, and NVIDIA. They are building an AI infrastructure, and they all told us last week that they saw a positive inflection point in AI demand. There is increasing need for compute, and those companies are responsibly building out that compute. There's a whole other category of bad behavior, using debt to finance, very expensive debt to finance data center build out, related party transactions where you're investing in your customer and then helping them borrow even more money to buy more of your product. Both things are happening simultaneously. But again, I point out Microsoft, NVIDIA, Meta, Google, all trading, Amazon, all trading at less than 30 times earnings. Those are attractive valuations for companies that have seen a positive inflection point. As you start getting into this more speculative bets, your Oracle, your CoreWeave, your Oklo, those are extraordinary. Even your AMD and Broadcom, those are extraordinarily expensive on what is much more speculative, much more reliant on the ability to raise debt capital, expensive debt capital that may or may not be available for very long. So those two things are coexisting. It's important to focus on the real companies doing the real build out based on real demand.
Gil, it's always great to get your perspective on this stuff. Thank you so much.
Thank you.
Coming up, we're going to be digging into more earnings, notably from Uber and Spotify. We'll be right back. Uber shares are falling despite the ride-hailing company posting third quarter revenue that beat expectations. Wall Street seemingly sees bumps in the road ahead. It has to do, looks like, with earnings. Let's bring in Scott Devitt, Wedbush Securities Managing Director of Equity Research. Hey, Scott, it's good to see you. So, yes, the revenue beat, but operating income looked like it trailed estimates here. So what's sort of your high-level view on the quarter?
Good morning, Julie. I think the quarter was, outstanding. And, if I think the bigger issue here is unrelated to like the income statement and the quarter and more related to this kind of potential seismic change that's happening in this ride sharing industry with the, introduction of autonomous vehicles and how that affects Uber's business over time. So if you were to take out this kind of technology risk that exists and look at the business, I would say that the stock is a clear buy. When you incorporate that in, there's just a lot of uncertainty of how this is going to play out. If you listen to Uber and Lyft talk about this, they claim that autonomous is going to be fragmented just like human drivers, and that their place will not change because that distribution is needed. But if you look at the scaling and the technology behind what companies like Waymo and Tesla offer, it's very possible that the supply gets much more concentrated, and that some of these companies, those two in particular, don't need distribution help. And that's a problem for Uber.
So Scott, just as I'm trying to wrap my head around, you're saying this is so an Uber is almost the inverse of a Tesla. In other words, Tesla's business right now is pretty lousy, right? But people buy it because they see this future, whether it be autonomous, whether it be robots. In the case of Uber, their business today, pretty good, but you're concerned about those perils coming down the pike. Is that the right way to think about it?
100%. And so you look at the cash flow multiple of Uber, and it looks quite different than Tesla, right? And you look at the stock performance of the two, and Tesla at the moment anyway is doing better. And so I think it's just an investor perception of the potential that Tesla has, both in autonomous vehicles and robotics, and the risk that's present with Uber. Now, should Uber prove to be correct in terms of their own assertions of the way autonomous plays out, then the stock will be, we have proven to be a buy here. But there's just a lot of uncertainty in that regard. I mean,
what is certain is that their gross bookings are rising, right? And that they say fourth quarter bookings are going to be up 18 to 22%. So is there an argument to be made for buying it on those solid fundamentals today?
Sure. I think the challenge is that BlackBerry was doing well before the iPhone came along. Specialty retail did well before Amazon came along. The media industry did well before Netflix came along. And these things kind of grow very slowly in society. Nobody almost knows that they exist. And then before you know it, the entire world's changed. And I think the potential with autonomous vehicles is that it changes everything in transportation. That may not prove to be true in terms of that it's concentrated to just a few technology companies, in terms of that the technology itself, the autonomous driving technology, proves to be the moat. The autonomous aspect could become commoditized, which could lead a number of players to participate even as we shift from humans to autonomous driving. And in that case, the middleman retains its value. And that's why, I think that you have the volatility in the stock that you have, and kind of a wait and see approach over the next probably 6 to 18 months as autonomous becomes a bigger factor in overall transportation.
So dig into that sort of middleman model a little bit more. What would the best case scenario be then for Uber?
So if you're a middleman in the case of Uber, Booking, eBay, you want fragmentation of supply. And fragmentation of supply gives power to the middleman. Concentration of supply, say the airline industry, pays less for distribution. So the online travel agencies make significantly less from selling an airline ticket than they do a hotel room, because there's a lot more concentration of supply. So if you carry that or parallel that to, this case, you have a lot of very small vendors on one side of this Uber marketplace. And if that changes, so the power of the marketplace shifts to the suppliers, and in some cases, like in the case of Tesla, it doesn't need distribution help, then you start to have take rate risk. And then you also have the possibility and likelihood that volume actually gets siphoned off the marketplace over time if Tesla does prove to be successful.
Well, I guess that's the other big if, right, Scott? Because this assumes then that the supply will be consolidated in the hands of one effectively, or I guess Waymo would be the other one, and Waymo has a lot more vehicles driving around by themselves on the road right now than Tesla does, and Waymo doesn't have its own platform, right?
That's true. So Tesla's vertically integrated, but the technology is not proven, or at least the regulators haven't approved it to be not exist without a human assist currently. But if you go right into Waymo, it's pretty amazing. This past weekend in a Tesla, I did a 12-hour round trip, never touched the steering wheel. So the technology is powerful. I think the technology, in fact, in the case of Tesla, is already there or very close to being there. But the regulators are behind. And so as the regulators catch up, like say in the case of Austin, if they allow that human in the passenger seat to be removed, then all of a sudden Tesla's robotaxi business in Austin can scale on an S or J curve, however you think of the world, very quickly. And that is imminent. In fact, Elon said by the end of the year, Elon tends to maybe exaggerate a little bit in terms of timing, but even if it's in the next 6 to 9 months, that's significant.
He does? I never noticed that, Scott. No, I'm just kidding. It should be really interesting to follow, and this is a really interesting perspective on the Uber story. Thank you so much. Appreciate it.
Thank you, Julie.
Spotify gave a strong outlook after its third quarter results beat expectations on sales and users. The company also planning for CEO Daniel Ek to transition to executive chairman. Joining us for more on this is Santosh Rao, partner and head of research for Manhattan Venture Partners. Santosh, good to see you. Now,
good to see you.
For a while there, this morning, it looked like Spotify was in the Palantir category, right? That the metrics looked pretty good, but the stock was lower. Now it's a little bit higher again, but not by very much. So what do you think is going on here? And was the quarter indeed a strong quarter?
Yes, great to be here. The quarter was very good, a good comeback quarter after last quarter, which was down quarter. They missed on revenue and guidance and everything. But here it's all good. So they're back on track. I don't think anything was really wrong with that. The market is very bad at this point, the macro market. So I think they're getting hit because of that. But the stock should be up a lot more. It opened pretty high and then it kind of pulled back. But then everything is pulling back at this point. So I would say this was a good quarter across the board. They're doing the right things, and it's the best of breed, pure play, or music company, and so music platform rather. So I don't see any issues with this quarter, and I see a good outlook going forward too.
Santosh, we are seeing a lot of concern out there about consumer spending, particularly at the low end. And if people are going to be doing sort of streaming subscription audits, right, and figuring out where they can save a little money, do you think that Spotify subscription is going to be at risk?
Yes, I mean, at a very high level, yes. I mean, that makes sense. People will cut back. It's a discretionary to some extent, but not to a big extent, because it has become part of our lives. It's a very integral part of our lives. It's become a utility-like offering. So people like that. And in tough times, of course, I think I would argue that people need more music, more calming effect. So yes, to the extent they can afford, and $11.99 for a premium service is not that much. So I don't think that's an issue. But at a very high level, yes, on the edges rather, there can be some corrosion of people moving to ad-based models, ad-based platform as opposed to the premium model. But yes, but overall, I think the value proposition is very good with Spotify. The collection, the product mix, and more offerings coming in. They introduced 30 new products this quarter, the 3Q. So I think that's good. They're growing, they're innovating, they're staying with the market, and it's a very competitive market. So there is competition, there are choices, even though they are the incumbent leaders. Yes, everyone's nipping at their heels, so to speak. But they're good. They're maintaining their lead, they're innovating, they're progressing. So I think they'll continue to execute well.
It was interesting to see that ad-supported revenue did fall by 8% year over year. What did you make of that, and what does that imply about that offering?
Yeah, I think that's an issue, I would say. As I read some reports where people are really mad at too many ads in their ads intruding on their whole experience. I've seen that with the podcast, with all the other ones as well. So I think that irritation, they have to work on that, make it more efficient in terms of showing the ads. So I think they'll work on that. But that happens a lot. It's a free platform there. So I don't think that's an issue. I mean, that is an issue to some extent, but they can correct that in terms of streamlining their ad offerings and doing it more constructively rather than just kind of jamming everything in there. So I think that they'll work on that.
Do you have any concerns about Daniel Ek moving into that executive chairman role and ceding the reins of the day-to-day to co-CEOs?
No, I don't think so. I think they had prepared the succession plan very well. So him moving on, I don't think should matter. And it would have shown. The results are good, and it will continue. They will continue on the same strategy going forward as well. So I don't see a big fall. It's not like Musk moving away from Tesla. It's not that. This is not a one-man company. It is a whole. It's a platform that works, and the offering is what drives this whole platform. So it's not really a CEO-driven company. It's more a complete package there. So I don't see any disruption because of that.
And today it seems like one of the themes of the day is valuations, right? And Palantir, that's very much part of the discussion. Spotify is priced high in terms of its multiples. Is that a concern at all for you? Like, would you be adding at these levels or kind of wait for a pullback to do so?
Well, I mean, I think the valuation is reasonable considering the growth ahead and the demand for streaming services, their services especially. So I would, they command a premium valuation. So how high? I think let the market decide. The whole industry, the whole market is going through a change. There is a sort of correction going on in terms of the valuation. Did the whole market run up too much across the board, across sectors? So that issue is there. But I don't think it's really out of really excessive in terms of valuation. There may be slight cut here and there, but I would continue to buy. Any pullback I would buy because this has a long runway ahead.
Santosh, good to see you. Thank you.
Take care. Thank you.
We got much more markets action coming up, and we're going to bring you the calls of the day next on Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tobama. We're live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Broadcom, CyberArk, and DraftKings. Broadcom got a vote of confidence this morning from Jefferies. The financial firm named Broadcom its new top pick, saying the chipmaker is at an inflection point as demand for custom AI chips increases across hyperscalers. The firm also raised its price target on the company to $480. That's up from $415. And now that's the most bullish call on the street. The average 12-month price target is $398 per share. Next up, we're taking a closer look at shares of CyberArk. Citi downgraded shares of security platform to neutral from buy. The move was based on its pending takeover by Palo Alto Networks. Citi sees the deal closing on the current terms and does not expect a competing offer to emerge. And last up, DraftKings. Bank of America downgraded shares to neutral for buy. The firm said sport outcomes in the third and fourth quarter raised concerns around volatility and long-term earnings power. Plus, Bank of America thinks the prediction markets present a challenging narrative near term. The firm also cut its price target to $35, down from $48. Keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Metsera, Sarepta Therapeutics, and Hertz. First up is Metsera. Both Pfizer and Novo Nordisk have now boosted their bids for the obesity startup. Novo's updated offer values Metsera at $10 billion. That is higher than the enhanced offer from Pfizer, which values the company at about $8.1 billion. Pfizer's got 2 days to negotiate potential adjustments to its offer, Metsera said. Those latest bids underscore surging interest in one of the fastest growing areas in medicine. We're talking about the obesity market, which is projected to reach $95 billion by 2030. And remember also, Pfizer has filed a couple of lawsuits to try to prevent Novo from getting hold of Metsera. And sticking with pharmaceuticals, let's talk about Sarepta. Those shares are plunging amid the failure of 2 of its approved drugs in a key trial and weak forecast for its top-selling gene therapy, that raising concerns about the strength of the company's portfolio. The trial setback compounds Sarepta's woes as it's already facing scrutiny and restrictions related to its top-selling gene therapy. The shares right now down 30%. And finally, Hertz, the car rental giant, swinging to a profit, reporting third quarter results that beat expectations, but sales did fall by 3.8% year on year to about $2.5 billion. On the plus side, Hertz did expand its direct-to-consumer car sales platform, increasing retail fleet sales by 570 basis points this year compared with the same period last year. And in August, remember, it said it had started to sell used cars on Amazon in a move intended to offload more vehicles to retail buyers. That could be a path to higher profits. Those shares up 37%. Hertz, by the way, has been an on and off meme stock favorite, so that could be contributing to some of the move today. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We are counting down to a big day here at Yahoo Finance. Invest. On November 13th, starting at 8 a.m. Eastern, we got a full day of live coverage of the key themes driving the market, AI, crypto, and much more, with top guests you'll want to hear from. They include the biggest names with tips to help you build your wealth, including Palantir CEO Alex Karp. Don't miss Yahoo Finance Invest. That's on November 13th.
Austin, thank you so much for joining me. It is great to see you again and great to have you back on the program.
Thank you for having me back. Yeah, thank you.
You had said before the policy meeting that you were somewhat uneasy about front-loading rate cuts based solely on slowing payroll growth, and that at the same time, inflation had been moving in the wrong direction, and just counting on inflation to be transitory made you uneasy. So why did you vote in favor of cutting rates last week? Was there anything that changed that caused you to want to take out more insurance?
Well, before the last meeting, not this November meeting, but in September, we issue the statement of economic projections, our dot plot projections of where the economy is going to be and where rates are going to be. And at that time, I thought there would be 2 rate cuts for the year. I'm balancing off 2 things. One, as you know, I believe that the place rates will ultimately settle is a fair bit below where we are today. And as long as we can get the dust out of the air, I still think that golden path is possible. And I'm trying to weigh that off with these concerns about front loading, especially when we have the data shut down. We're getting some information about the job market, and we have very little private sector information about inflation. So I think we want to be wary, but I'm still just trying to balance those off. Not much change since the September SEPs, and so I had no problem with that.
So, Austin, you're saying you're trying to sort of look through all this dust, waiting for it to settle. You had penciled in 2 rate cuts for this year, and Chair Powell had said after the policy meeting last week during his press conference that there's a feeling that you've cut twice and you're now 150 basis points closer to neutral than you were a year ago, and that there is a growing chorus on the committee that perhaps maybe you should wait. Are you one of the chorus?
I'm not supposed to say anything about what other folks say. In my mind, as you know, I am uneasy with front-loading rate cuts. I do believe rates will come down, but in a way, rates should come down with inflation. We've got to, if we're just going to count on the inflation that we've seen here, where the last 3 months core inflation is running 3.6% at an annualized rate, And core services, I think, are running close to 4% as annualized rate for the last 3 months. That's worrying because that's going the wrong way. If we're just counting on that to go away because it's transitory, that makes me uneasy. So I'm not decided for what I think about the next meeting, and we are still going to get at least some private sector observations and the Chicago Fed's labor market indicators telling us some about the job market. We're probably not going to get much on the inflation side, so I am a little wary, and my threshold for cutting is a little bit higher than it was in the last 2 meetings.
So to your point, Fed Chair Powell used the analogy of when it's foggy, you want to slow down, become a little bit more cautious. Is that a fair characterization for you? And how are you viewing the balance of risks? Fully recognizing that we haven't had official data on the labor market side because of the government shutdown. It sounds like you may be more worried about inflation than employment now when you look at the balance of risks.
I've been a little more worried about inflation than the job market if you think of it as a balance of risk, for the reason that other than payroll job growth, if you look at things like the unemployment rate or other rates that are less affected by population changes or immigration policy, those things have been pretty stable for some time. If you look over the last 12 months, the unemployment rate has not been going up. We haven't seen a big uptick in layoffs, which if this were the beginning of recession or deterioration of the labor market that was rapid, you would expect to see higher layoffs or firing, and we haven't seen that. There's still concerns on that side. And as you say, we're going to get some private sector data, so we can at least keep observing that. But I just want to emphasize, be very careful at moments of transition where you're trying to figure out whether the economy is turning, relying too heavily on 12-month backward-looking numbers like the 12-month trailing inflation. Each month we get a number, and 11 of the months we already knew. The new information is only for that new month. So the fact that the last 3 months inflation is not going down but is instead going up, including in some categories that are not driven by tariffs like services, those are areas of concern. And so that's a little bit, the last time you looked out the window, there was a mountain lion sitting in your front yard. So before you let Fluffy out to go run around, just let's at least get one more look.
All right. Well, aside from Fluffy, I do want to come back to the job market because, yes, payroll growth did slow over the summer months. And since then, you sort of have been in the dark as far as official data. But last week, we saw some major layoff announcements from the likes of Amazon to UPS. If you did look at private sector data, ADP's measure turned negative for the month of September. We're going to get another measure this coming Wednesday. And the Beige Book revealed that employers are looking at cutting headcount either through attrition or layoffs due to policy uncertainty, weaker demand, and AI. Does that not worry you? Do you think that perhaps payroll growth has decelerated further since you have gotten official data?
It might have, and that's why, as I say, I'm not decided going into the next meeting. I want to see how things are playing out. I do think the public announcements of layoffs, you would expect, if that is an immediate business cycle driven matter, that you would start to see an uptick in the official unemployment insurance statistics or the layoff statistics, or you would get WARN Act type data of that form that would give you a little bit of a heads up of what was coming in the job market. I do think the hiring rate is low. That's among the weakest things in the economy at the moment. And that's made it particularly tough for new graduates and young people. But a low hiring, low firing economy is unusual. That's the kind of economy that you expect when there's a lot of uncertainty. Normally in the business cycle, you would have low hiring, high firing, or low firing, high hiring. When you get uncertainty, both of those go up as people kind of pull back and say they want to wait to see how things are going before they make decisions. This whole second part of what's going on in the job market, if it is being driven by AI, if it is concentrated in the tech sector, that doesn't feel as much like the business cycle to me and economic stabilization. That feels like more of a structural shift in what sectors are going to be employing people. So we have to think through, what does that imply for monetary policy? That's a little different than if you were afraid that we were going into recession.
Yeah, so to your point, what is all of this telling you about the outlook for the economy in a cyclical sense, right? Not a structural sense, because that is what you have control over at the Federal Reserve. Perhaps are we at a turning point in the economy, given what we're seeing in private sector job market data that GDP data is not yet reflecting?
Yeah, look, I always say one of the hardest things a central bank ever has to do is get the timing right on moments of transition. And that's especially difficult if you have squished bugs covering the windshield and you can't see whether you're still on the road. And when they shut down the data, the official data, that's the circumstance we're in. So I don't know that it's decided. I'm not decided going into the December meeting. I am nervous about the inflation side of the ledger, where you've seen inflation above the target for 4.5 years, and it's trending the wrong way. I believe on the other side, rates can come down a fair amount. It would probably be most judicious to have the rates come down with inflation. So let's get some observations that document that inflation is coming down and that the uptick we've seen is transitory. But we've got to weigh that off. If the job market starts to deteriorate in a more significant way, then that would change the balance of risk.
Treasury Secretary Scott Bessent said yesterday that he believes that parts of our economy, particularly housing, may be in a recession already. Sounds like you may disagree with that. What are your thoughts on that?
Well, I think he's right that the housing construction sector's been weak. It has been weak now for some time. The three most interest rate sensitive parts of the economy usually that give you a sense of the business cycle are housing, consumer durables, and business investment. I think he's right to highlight housing's been weak. Consumer durables have been pretty resilient. And you saw, as you said, the GDP numbers coming in and consumer spending coming in pretty solid. And business investment has been kind of off the chain. Now, much of that driven by the AI boom, so that might not be cyclical, but the interest rate sensitive parts of the economy don't feel like they overwhelmingly point to that we're in a slowdown. I think that the economy has been pretty strong. The economy is pretty solid and has been. There's weakness in sectors, and anybody who's dependent on intermediate goods that the tariffs are applying to has been suffering. But other parts of the economy continue to grow, and overall consumer spending remains the main driver of solidity. Is that, of the solidness of the economy has been largely based on consumer confidence.
Well, Austin, unfortunately, we're out of time. We'll have to leave the conversation there. Always so many more questions for you. So appreciate your time and insight this morning. Hope you'll come back and see us soon.
Yeah, anytime, Jennifer. Thank you for having me.
90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. We have seen sort of a risk-off tenor overtake trading today. It's in the wake of Palantir, which came out and reported strong earnings by pretty much every metric, and yet the stock is falling. But that's on the back of a more than 150% rally this year. So there's definitely some valuation concerns that seem to be at least part of the discussion today. The NASDAQ doing the worst of the three major averages, down about 1.1%. The S&P falling about 2/3. The Dow down about 120 points, about 0.25%. And all of this as we have another busy week for tech earnings. Names like AMD and Qualcomm are set to report as soon as this afternoon. Investors balancing what's been a positive earnings season so far against growing concerns of a potential AI bubble. That, again, has weighed on stocks today. Here with a look at what to expect, plus a broader playbook for the tech sector, is Maribel Lopez, Lopez Research founder. Maribel, good to see you. Thanks for being with us. I want to sort of zero in on a couple stocks and then we can broaden it out. And let's start with AMD and what we could hear from the company, which has seemed to have been gaining steam in terms of the headlines and the progress that it's been making.
So if you look at what happened with the recent OpenAI deal, I think that really pushed AMD forward in a meaningful way, both in terms of people saying they're a good alternative for some of the NVIDIA product category, but also that there's some standing orders for them moving forward. I think the concern for a company like AMD right now is you place an order or get an order placed with you, but that doesn't mean you're going to see that in this quarter or even the next quarter. We're looking at 2026 or some of that. So it's like, how do we bridge the gap of that revenue between now and 26 is, I think, really what investors are going to be concerned with. It's had a huge rally. It's really benefiting from, the AI boom momentum. They are actually one of the few reasonable competitors to NVIDIA, but I think that just makes expectations very high based on what they can deliver in 2025.
Well, and I was going to say that, the expectations for fundamental performance are one thing, and then there's, of course, the valuation. It's actually valued right now above where NVIDIA is valued. So if you're an investor trying to figure out what to do, what do you do with that information?
Honestly, the market is just extremely frothy right now. It's very difficult to say that the fundamentals really support the valuations that we have today. There's just been a tremendous amount of enthusiasm. Everybody understands that AI is going to change the world in many different ways, and they want in on that. So the buys in many cases have been unrealistic, pushing us to ridiculous highs. However, having said that, we have seen ridiculous demand for compute capacity, and there are only a few companies that are really benefiting from the picks and shovels side of that. That will be NVIDIA, that will be AMD. We had hoped it would be Intel. We're still on a wait and see for that with Intel, and Qualcomm seems to be coming in strong on the other side right now with some new announcements. So there is still a tremendous amount of opportunity, but the enthusiasm has just given us sky-high valuation. So it's not that the opportunity isn't there, it's whether or not we can meet what in some cases seems like unrealistic expectations.
Let's zero in on one of the names you just mentioned. That's Qualcomm. And as you alluded to, the company just introduced a data center chip, which has not been its typical offering. It's also trading at a much lower valuation than all those other stocks. The stock is up this year, but only by about 15%. So is that one that people should be looking at as a relative bargain, at least compared with some of the others?
So when I look at the industry fundamentals of Qualcomm, I see that there's some really good opportunity on two ends of the stack. So we have a future edge AI computing game that Qualcomm is square in the zone for. This would be the equivalent of the next generation of mobile at the edge. So there's that market. But then they just introduced this new data center set of chips, which the thing about that we have to think about, that's a timing game. If you've introduced those chips now, you've discussed that with a bunch of different buyers, those still have to be put into the builds. Those builds can be a year or more away at this point now. So the question is, can they accelerate somebody adopting that design? And it's a newer design, so therefore there's some inherent discussion of what's the risk around that. But the opportunity for them, right now, this is an NVIDIA game in the data center for the most part, right? So NVIDIA is the company that you will be taking share from, and there just aren't a lot of alternatives right now. So I think everybody's really interested in making sure that they have viable alternatives. And these are good companies. These aren't, fly-by-night startups that you're worried are going to shut their doors next week and won't be able to support you. So we see a tremendous opportunity for future industry-led growth with NVIDIA. Whether or not that translates into their stock valuation, we're not clear on that yet, but having said that, there's definitely industry opportunity and momentum available for Qualcomm.
So, Maribel, we know about the infrastructure play, which is all of these companies that you're talking about. As an investor, if you want to then sort of take the next step to use case, where do you even look right now? Because it still feels early, and I know there's sort of a lot of confusion about where it is going to manifest.
Yeah, where we're seeing actually AI being adopted in the enterprise is what I would call some of the very easy, straight up use cases. Like if you look at the customer service, customer experience market right now, there's a tremendous opportunity to leverage AI to do better experiences, to add AI into those product portfolios. So we're looking at companies like NICE, Five9, ServiceNow, Zendesk, all of these have presence within organizations. They're leveraging that AI. They have an opportunity to either deepen that relationship or have AI incremental revenue add-on at this point. We're also seeing the same thing happening in the networking category. So if you look at all of the people that are in the category of the Ciscos, the Extremes, the Palo Altos, there's definitely opportunity for those style companies because they can prove value when they add ROI with AI to their portfolio. So we're seeing some opportunities there from the enterprise buy, but it's still early days. Most of what we hear about in the enterprise is that, these 90 to 95% failure rates, it's not that dire, but we still need to actually tie AI to a return on investment use case. And the only company that's really been talking a lot about that, doing well with that dialogue right now, is Microsoft, because they've had extreme success in their Copilot launches.
So Maribel, there is this need to prove that ROI and prove that success at the same time that you have these frothy valuations. So at a time when there are these concerns about the valuations, where should investors sort of be looking for fault lines, if you will? Like what should we be examining?
So I think this gets back to what we were talking about. If you're not going to be the person providing the infrastructure, then it's, do you actually have a foothold in the organization where you can take AI, put it into your product, and basically create a new category of services? So if you look at companies like Salesforce, they've done a good job of discussing how they can leverage AI to deliver into new markets, not just into the CRM category, but they're talking about in the HR category, right? If you look at someone like SAP, they're actually defending ground, but they're using AI to defend that ground. So the fault lines are basically when you look at somebody building in AI, can you see their customer base actually adding additional money to, say, a subscription service for that? And if you can't, then you can say, well, that's a nice to have, but it's just going to be a cost for them. It's not going to be something that's going to drive future revenue growth for them.
Maribel, always good to get your perspective. Thank you.
Thank you.
We are counting down to a big day here at Yahoo Finance. Invest on November 13th, starting at 8 a.m. Eastern. We've got a full day of live coverage of the key themes driving the market. That includes AI, crypto, and much more, with the top guests you'll want to hear from. We got the biggest names with tips to help you build your wealth. One of the folks we're excited about, Palantir CEO Alex Karp. Don't miss Yahoo Finance Invest on November 13th. Good to see you, Rick.
Good to be here.
Thanks for coming in.
Yeah, pleasure.
So you heard what Austin was just saying.
Yep.
And, it's almost remarkable to me the extent to which there is still a pricing in that there will be a cut in December. Do you think it'll happen?
Yeah, I think it will happen. But listen, one thing I've learned about markets is you have to interpret what they are saying. There is a part of this committee that definitely would like to wait and evaluate the data. I think they can go. I think they should go. I think they can go quicker. But I respect the fact that inflation is running a little higher. I would argue, you're still, if you take 6 months core PCE, you're running at about 2.5%. Other metrics, you're running closer to 3%. My only view being that's not an infectious inflationary expectation dynamic that allows the Fed to move. In fact, in the market today, you can buy 5-year inflation break-evens at 2.5%. It's like the market thinks inflation is a problem, such that I think the window is there. I have a stronger view that I think labor is a tricky thing from here, and I think there is significant displacement on labor that we're going to see over the next couple of years. Last week being an embodiment of that when we heard from Amazon, UPS. Technology is changing the world. I mean, I was on a call with the CEO today, and we're talking about data center investment. When you go into data centers, you don't see a lot of people. You see a huge amount of CapEx. So it buoys the economy. You just don't see a lot of people in those facilities.
No, although you have to build them, right? You have to build them, you have to outfit them. That all requires people. But then when they're done, to your point, there's nobody there.
That's right. And by the way, it's not just AI that's creating this productivity. You talk about things around inventory management, logistics, client procurement, predictive maintenance. I mean, productivity is exploding everywhere. It means you see it in all the corporate earnings. Companies are doing well, the revenues are decent, cost of goods sold is coming down, their SG&A is coming down. You can operate with a lower cost threshold. That's why you're seeing M&A that's so high. I got to get bigger, I got to vertically integrate, I got to use data, I've got to use AI, and I don't need as much fixed infrastructure, including people.
So this so-called low hiring, low firing environment that we keep talking about, has that already changed? Are we just not seeing it in the data yet, but we have the anecdotal evidence?
So, listen, there's no doubt that is the best characterization of where we are from a labor perspective today. My sense is companies are waiting, and you're seeing, I think today, I talked to CEOs who tell you, I'm comfortable with my labor force today, you saw Walmart freeze hiring. Let's stay where we are, let's see if we can grow our business, and then you'll see some companies that proactively will reduce labor. I think, so if you take the last 4 months of data that we have gotten, and I don't think it's going to change much. The data we think is going to come is going to show the same thing. The last 4 months, if you strip out healthcare is not cyclical, it's not interest rate sensitive. We have negative job growth. I think that is something that is going to be persistent. Hopefully, the economy continues to be resilient, which I think it will. Actually, the economy's in good shape. I think the economy's in good shape, companies are in great shape. I think labor, not so much.
Okay, so here's the question then. So say the Fed cuts because they're concerned about the labor market. What does that do for the labor market? How does it help the labor market?
So there's a few things. By the way, you brought up the most salient issue. So by the way, what is the interest rate effect today? In inflation, you think about what's sticky inflation? Healthcare, insurance, education, pretty hard to get interest rates to help healthcare, insurance, education. Shelter is actually one that actually you can help. You bring the rate down, you help inflation.
But shelter's not the one that's the problem as much right now. As Austin just pointed out, it's the services inflation right now that's accelerating a little bit.
Those are the ones that are, but those are really, right. But shelter is coming down. By the way, something you're starting to see is the mortgage rate has come down to around 6%. All of a sudden, existing home sales are higher. You build more houses. You look at the earnings reports from the D.R. Hortons, the KB Homes, the Lennars. We're not building enough houses. Why? Because the home builders have to subsidize the mortgage rate. If you get that rate down, we'll get more housing. You'll bring down shelter. Listen, I think shelter is still the trickiest one. And what helps when you build more houses? Labor mobility. You lose your job in one state, I can move to another state. You create more velocity, and you can't AI building a house. Your point about data center.
Right.
If we can put a lot of people to work, there are so many reasons for doing it. Point being, listen, the interest rate tool today doesn't really affect CapEx because who's spending on CapEx? The big hyperscalers, et cetera. They fund through free cash flow.
And they also have a fiscal tailwind. I mean, not just AI, but in general,
Totally.
There's a fiscal tailwind for CapEx.
Totally. So it's not really, interest rate doesn't really affect CapEx like it used to in the 70s and 80s. Now, what is the interest rate affecting? Small business, 44% of the hiring in the United States. By the way, slowing, having a tough time. We need to help small business. Low income that borrows on their credit card, borrows student loan, borrows through other mechanisms. That is hurting. Housing is hurting. And by the way, the US government, 90% of what we finance in treasuries is 2 years and in. You keep the interest rate 100 basis points above where it should be, and that costs the country $100 billion per annum. So point being, the interest rate tool is not like it was in years ago when it was the calibrator, it was the modulator of growth in the economy. It affects the people that are getting hurt today, and it doesn't really do much for CapEx.
And so you think they will cut in December as a
Yeah.
result of all of this reasoning?
I do.
We talked about a year ago at our big Invest conference, and then I quoted you for months afterwards because at that. But what's so fascinating to me is how much the world has changed since then. Because at that time we were talking a lot about the deficit and how concerned some corners of the market were, but. If you remember, you said it's not the shark closest to the boat. It is not the most immediate threat. And in fact, that threat has seemed to recede even more between now and then.
Yeah.
Do you think that is, what do you think is the shark closest to the boat? And do you think it's okay that we're not as worried about the deficits right now?
So, I think I said it then, and I'll say it today. I think the amount of debt we have in the country is still a tail risk, but I think it is only a tail risk. We have to keep refinancing. By the way, the fact that 90% of our debt, 89% exactly, is 2 years in, we got to keep rolling immense amounts of debt. That is still the tail risk today. I haven't gone through too many crises in my life, from the housing crisis to emerging market crises, European crisis, financial crisis. It all centers around where the vulnerabilities are, and that's the debt. Today it's at the U.S. government. Listen, I think there are a lot of things happening that allow us, as long as the economy grows, and this is part of my thesis around, we got to run the economy with 5% nominal GDP. I think we'll hit it this year. I think there's a good chance we'll hit it next year. If you keep nominal GDP over the cost of the debt, meaning we get the cost of the debt down a bit, we keep nominal GDP, we'll actually de-lever the economy. So it is still the risk that's out there. Assuming the economy grows and we get the cost of the debt down, we'll be okay. What
is the biggest risk then?
So away from that, I'd say complacency. And when I see in markets, you start to see some things, there's a lot of money in the system. Part of why the equity market, I think, will keep going up. The technicals are extraordinary. People are willing to, to do things to generate return. That to me is out there. And then I don't see a lot. I feel good about the U.S. economy. The only problem with the economy is it's bifurcated. It's the most bifurcated economy I've ever seen. You got working a couple of cylinders on CapEx, a couple of cylinders, high income spending, low income not. So anyway, I think the economy's okay. Geopolitics hopefully is stable. U.S.-China relationship hopefully is stable. To me, it's just complacency and people putting money to work.
Well, and you said maybe going out the risk spectrum a little bit. You didn't say the word bubble, but I'll say the word bubble because it's been uttered by almost everybody lately. Is that... are we looking at that level of speculative behavior, do you think?
When I say no, the big companies today, the ROE these companies are throwing off, I actually went through the earnings that came out last week, and I was looking at the free cash flow that these companies are throwing off. It's like nothing I've ever seen. If you take free cash flow, just the companies, there was a Google, Meta, Microsoft, and you look at the amount of, not just revenues, not just cash flow, free cash flow after you've spent on CapEx, they're creating major companies every quarter. And then the multiple, you look at they're trading at 20, 25, 26 times earnings. Now, I see a lot of deals, particularly in the private markets, that are no cash flow, no revenue for the next 2 or 3 years. And by the way, some are good business models. My guess is most of them will fall away, similar to what you saw in the actual bubble back in 2000, when you didn't have any cash flow, you certainly didn't have any revenues. So I do see some of that in the private markets, but generally in the public markets, I don't think it's overdone.
Are the private credit markets? Let's leave aside the sort of tricolor First Brands situations that we saw. Elsewhere, do you think there are problems in private credit?
From a systemic point of view, no. We do a load of financing in real estate, commercial, resi, bilateral credit, bilateral finance. Generally not. I will say things that get auctioned off. Like whenever there's a big financing that gets auctioned off, or somebody wants to put their name on something that gets auctioned, like I look at the levels, sometimes it's through the public markets, and think, why would you ever do that? There is some stuff, and around the edges in like financing software, what's going to happen with software and AI, there's some stuff around the edges that I think are tricky, but not a systemic, like we saw in prior decades.
All right, Rick, I got to end with this. You are reportedly on the short list to be the next Federal Reserve Chair. I know you can't say very much about it, so I would ask it this way. Is that a job that somebody can say no to if they are offered it?
I'd say being on a list is an unbelievable honor for me, and everybody, will evaluate it based on, their own particular thought process. Listen, it's a huge honor, and I'm going to go through my process, and I will say today, the investing side of what we're doing is, you were kind enough. We did this ETF called BINC. Mm-hmm. I mean, the amount's up to $14 billion, and it's pretty incredible. There's some fun things to do in the investment arena. So, anyway, I know it's not a great answer, but that's
you're
where I'm
enjoying what you're doing right now, is what you're saying.
I am.
Okay. Good to know, Rick. We'll keep talking, I'm sure.